Okay, our market outlook this week will start in about 45 seconds. Just a reminder, at 6 p.m. this evening, I have a live information session on YouTube and Ask Me Anything for Level 1 candidates who are interested in 2023 or 2024. That will start at 6 p.m. Eastern Standard Time, which, if you think better geographically, is either New York or Toronto time. One more notice here. We had our first live Q&A session for the Applied series at noon today. It went 2.5 hours long and I didn't get through all the questions. So the next live session, it says here, is April 30th, noon to 1:30. I will be adding an evening session in there as well later on in the evening, like 8:30 at night, to catch other parts of the world and to catch maybe the West Coast. So for April, we will have 2 live sessions for the Applied series. For everybody that was on today, thank you for all the fantastic questions that we got. If I didn't get to all of them, well, then you have something to ask me in April. Okay, let's head on in and see what happened in the past week. What an interesting week. Lots of day-to-day volatility, but over the course of the week, if we just looked at things over the course of the week, equity market is up 1.4%. If you look at the change in rates across here in the gray bar, you'd say those are small basis point moves. It must have been a boring week. It was anything but boring day to day. The only tenor here reflecting the Fed meeting is the 3-month. It's up 22 basis points. Everything else is uninterested in the Fed meeting. An increase of 25 basis points on Wednesday, and the 2-year week over week delivers a cut of 5 basis points in response. So that's a 30 basis point spread from what you think it should have been. Down 65 basis points since the beginning of the year. The Fed is up 50 basis points since the beginning of the year. Even the 10-year is down 50 basis points, while the target rate is up 50 basis points. The market is not fighting the Fed at this point. Months ago, January, I would say, it's fighting the Fed, because January, the market was already cutting rates, capital market rates, which was clearly fighting the Fed. And in February, with much of the Fed speak, that was the message that was put out there. This is different. This red ink on the screen right now is reflecting the market saying, oh, we believe the Fed. We believe what they're saying. We just don't believe they're going to be able to do it. The economy is not going to allow them to do it. Something more is going to break. And so they're anticipating, the bond market is anticipating a recession. The 2-year typically leads the Fed funds rate by a period of time, a number of weeks. So the 2-year is already signaling that it's done with this. You're going to have to cut rates. We're not betting on you pausing or pivoting, but that the economy will force your hand. That's it. So we're getting an uninversion of the capital market curve, the 2 to the 10, negative 38 basis points. It's been 263 days inverted now, another 4 basis points on the steepening. And the capital market curve will typically steepen when the 2-year starts signaling a recession and the 2-year starts dropping quickly. So you can see that it's down 65 basis points since the beginning of the year. The 10-year is only down 50 basis points. When you get to other curves, whether they be money market inversions or money market to capital market inversions, they tend to uninvert when the Fed starts cutting rates starts cutting the target rate. So we would expect those to deepen while capital market inversions steepen. So what do we have here? If you look here, these are all capital market inversions. They're all steepening. But look at your capital market to money market inversions. They're getting deeper in their inversion. We look at a money market inversion, the 3-month, 18 months out minus a current 3-month is now 190 basis points inverted, versus 166 last week, 131 the week before, 74 the week before that. So the money market inversions will get more deeply inverted. Money market to capital market will get more deeply inverted, but the capital market rates will begin to uninvert. That is being the process in front of every recession. and that we don't get a 3-month to 10-year uninversion until the target rate starts dropping. So we've already begun the first process towards the recession getting closer by the capital market inversions uninverting in anticipation, with the 2-year basically leading the Fed funds rate, anticipating the coming recession. Next meeting is May 3rd, 38 days away. And we have 5 risk factors before that, 5 big risk factors before that. We have 1 jobs report. May 3rd is a Wednesday. We don't get the May jobs report till May 5th, but you get 1 jobs report. I don't think that's going to give the Fed enough to say, oh, we need to cut. I would still look for job growth in that report. I don't know that I would see any job cuts. The initial claims just don't support job losses at this point. We got 1 more CPI report for the month of March. We'll get that mid-April. We don't get the April one till mid-May, so the Fed won't have that. But we'll get 2 more PCE reports. We got 1 coming up at the end of this week, and then we'll get 1 more at the end of April. So you've got 4 economic risk events, and May 13th we get the minutes from the March 23rd meeting, and see exactly what that conversation was about. That'll be interesting. But I think that we'll have, as always, we'll have most of that information from the Fed speak. That by the time we read the minutes, we'll say, yeah, we've heard all of this with all of the different Fed speak going on. Remember the Fed meeting talking about inflation. Powell said that, yeah, goods inflation, we're seeing something. Housing inflation is only a matter of time. But the one that they're concerned about the most, core services ex-housing, he said, we're not seeing any progress on. So that is really wage driven. So we're going to spend some time this week looking at the job, looking at initial claims, continuing claims, and looking at it over past periods of time. And interestingly enough, high interest rates do not cause unemployment. You would think that the higher you push your interest rates, the more initial claims would rise. They don't. In fact, initial claims tend to fall as interest rates rise. It's not until something breaks that initial claims begin to rise. Well, we did have something break. We'll see if that causes anything on initial claims. Fed speak for the week: Monday, Jefferson; Tuesday, Barr. This is testimony on Capitol Hill, 2 days of testimony. Thursday is Barkin and Waller, and Friday is Williams and Cook. Effective federal funds rate is now 4.83. This is interesting, right? The Fed is paying 4.83 on deposits. It's paying 4.80 on its reverse repo. So it seems to be the only one suffering higher interest rates, whereas everyone in the capital market is saying, you know, let the Fed pay higher interest rates. We're not gonna. Just cuts in rates. Reverse repo facility increased by $112 billion over the week, from $2.1 trillion to $2.2 trillion, and now at 4.8 cash outflow from the Fed. The probability of 0 at the next meeting is 88.2%. 25 basis points is 11.8%. I'm in the 0 camp at this point in time. I can't see the 25 unless the next CPI comes in with a bump up instead of down, and same with PCE. If it shows either no progress or a bump up, yeah, you could go another 25. But the question is did it even matter? Like, could they have gone 50 basis points at this meeting? Look at what the market did in response to a 25 basis point hike. Nothing. In fact, on the capital market rates, it actually cut rates, sort of suggesting that 25 basis point hike in the target rate is only really affecting the Fed funds rate and the SOFR rate, but is not really affecting any capital market rates on which credit tends to be based on. So it really didn't tighten credit conditions. The banking crisis did that. This 25 basis points was what? Nothing. It did nothing. They could have gone 50, and it would have had probably, if they had gone 50, the market would have priced in the sooner recession, and capital market rates would have went even lower at this point. So if they get to May and we still have this kind of malaise in the market that the bond market's expecting a recession, would 25 basis points change anything? We will see that mortgage rates dropped week over week on the back of a 25 basis point hike. Mortgage rates dropped 18 basis points on the back of a 25 basis point hike. So the market is not going along with this. So the Fed could pretty much hike wherever they want to, and it's not finding its way into capital markets. So I think when we get to the May 23rd meeting, the Fed may, sort of think about that and say, well, what's the point of hiking? It's not finding its way into the market. Even if we go 25, it's not. Or they may say, look, we can go 25, and what's the big deal? It's not finding its way in the market. I'd say you got to look at these four reports. If they don't give the Fed a reason, a good reason to pause, then yeah, 25. But if they come in kind of like what we've been seeing, maybe a little bit lighter, like CPI a little bit lighter, PCE a little bit lighter, I think zero is in there. June 14th. So we have the May 23rd meeting, then you have June 14th. We're at 5 right now. This is the upper range. We're at 5. There is a 72% probability that we will be at 5. In other words, a pause in May and no move in June to end at 5. There is a small probability we'll get to 5.25, which means it's pricing in this one hike, but no hikes in June. And 4.75. There is even some probability here that between May and June, you'll actually get a 25 basis point cut. I don't think you're going to get a cut until it's very clear that we're in a recession. So even if you see initial jobless claims get to 275, 300, 350, which is typically what it starts doing in front of a recession, starts climbing that way, I don't think the Fed will cut rates, but I think the 2-year will keep cutting rates. The market will keep cutting rates on the 2-year in anticipation of a cut. It's not until something really breaks that you get another event like SVB that then is just difficult to contain with just stepping in and saying, look, we'll backstop this, we'll backstop that. It'll be, if something else big breaks, there's where I think you're going to get the rate cuts. Is it going to happen before June? I don't know. This is the thing about these kind of events is you know they're going to happen. You don't know where they're going to happen, and you don't know when they're going to happen, but you know they're going to happen. It's like if you're a level 4 candidate and we're looking at liabilities, we classify liabilities as type 1, type 2, type 3, type 4. Type 1 liabilities are known amounts and known timing. A type 4 liability is you don't know how much it's going to be and you don't know when it's going to happen. That's property and casualty insurance. So you're insuring a bunch of buildings from, let's say, a fire, and statistics tell you that fires happen with a certain probability. So you do the calculation. You say this year we expect it to happen to 2 buildings, but we don't know where and we don't know how much. That's where we are right now. Real rates through the week have dropped, and lower real rates are supportive of higher present values of cash flows. So that may be what the equity market is responding to, but the present value of cash flows in the equity market has 2 components. You have your numerator, which is cash flows, and then you have your discount rate. And the real rate is the easier one to look at because it takes out the inflation component. And if you are forecasting real cash flows, you're forecasting changes in quantity without the change in price. The question is that valid to have growing quantities from this period going forward, such that earnings from this point would grow or at least not get hurt? If you have a recession, those real cash flows are going to suffer. The market seems to be pricing in a nice lower real discount rate and saying, let's just ignore the cash flows for now, nothing to see here. We have earnings that start in about 3 weeks with the banks. I'll show you that at the end of the video. We'll see what banks are reporting. First Republic is reporting. So guidance is going to be a big thing now that this has happened. Let's see what the guidance is. I think these cash flows are going to have to come down. We'll talk about what the forward 4-quarter earnings are and what different consensus happens to be. So, well, the real rates have dropped. Nominal rates have dropped by less, so break-even rates have increased over that period of time. This was just too low over here. 210 on a 5-year, 214 on a 7-year just seemed rather low. Even on the 10-year, heck, they were all low, right? So that seems getting a little bit more reasonable. For Fed funds futures, week over week, it doesn't look like much happened, but lots of volatility during the week. Last week, we were bottoming out in May at 95.215. Still May, 95.14. So 4.785 is now 4.86. Pretty much the same policy range. End of the year, December was 96.125 last week. Now it's 95.995. So 3.875 to 4.005. A little bit higher this week on the May implied rate and on the December implied rate. From May to December, negative 85.5 basis points. And again, this I don't believe is the market fighting the Fed. I think this is the market pricing in recession. That's basically 3 to 4 rate cuts from the May of 4.86, which implies no rate increase because we are already in the 4.75 to 5 policy range. And then just look at the steepness of that curve, right? The 1 year forward minus the current 1 year, negative 112 basis points. Last week it was negative 110. Using 1 month SOFR, if we go out to 2024, we can take the December 2024 1 month SOFR minus the December 23 1 month, and it is inverted 97 versus 78 the week before. This is 285 for December. It was 306, and December 23, 382 was 384. Not much movement in here, but 21 basis points on that one. For TLT, again, week over week, nothing happened, right? Down 0.15%. SPY was up 1.44%. I've made no changes to my TLT position. I still am short the 102 puts, and I have a spread on 110 to 115 for the January calls. I will roll up my puts at some point from the 102 Aprils to the 104 May puts. Implied volatility has dropped a bit. 13-week is down at 89% from 97%. I'd like there to be some volatility so that when I roll up, I get higher volatility. But in waiting, I risk that there'd be lower implied volatility and less richness in the premiums. But I do want to wait till Friday's PCE report to see how the bond market responds to that. I think the Fed is pretty much near the end of what it can do based on what the capital markets are doing by just ignoring the rate increases. I think they're pretty much at the end at this point. I don't know that they have another 25 in them. I'm betting more for 0, but even if they have another 25, that would be it, which means that I don't see TLT revisiting the 102, 101, 100 zone. I think it'll probably be supported at the 105, 104 at the worst. So I'll roll up to 104, and as TLT, as rates, yields keep dropping, as there's more and more signs of stress in the economy, I'll continue to roll up my puts and sort of chase TLT up by just rolling up puts. So I am looking at rolling up rolling up and forward from 102 to 104 and from April to May. Hopefully I'll get some volatility on that one. I did a little bit of calculating here on TLT just to figure out if I took a target price of 130 on TLT by year end, what change in yields do I need to see to get that? So you can think about being long TLT and having a target price, or being long TLT and having a target yield, and keeping your eye on yields and watching where the yield goes while TLT will respond. Year to date, it's up 7.56%. Now that is a total return. Total return meaning counting the distributions that you received, you're up 7.56%. It has a duration of 17.6. So the duration is calculated as the percentage change in the full value of the portfolio. So you have to add back the distributions to get what the basis point change was that probably caused that. So the change in yield on the portfolio, the change in its own yield, is about 43 basis points. Rates of or yields dropping 43 basis points, which improves the full value of the portfolio. Well, if you have distributions that are going out, it kind of messes that up, so you have to put them back in. So 7.56% total return, 43 basis point change. So I think, well, okay, let's get to a target price of 130. To get to a target price of 130, that has to be a total return price of 130. By December, you're going to have $2.34 in distributions, which means you will have a price of 127.66 on TLT to have the total return of 130. That is a 19.78% increase from where we are now, 106.58. Given its duration of 17.6, divide the percentage change by duration to turn it into basis points. 112 basis points on its yield. So I took that to the 30-year, saying, well, okay, let's just go to the highest duration bond. Let's go to the 30-year. It's got a 3.64. That would give it a target yield by December of 2.52%. Looking historically at the 30-year since 2000, 2.52 has been done before. In fact, it's been much lower than 2.52. 3 seems more reasonable based on just looking at the chart. 3 seems not unrealistic. So if the 30-year dropped to 3%, we would expect to see the price. This is not counting any distributions you'd receive by being long, but the price of TLT to be around 118.58. So, just in my head, I wanted to think in terms of yield change as opposed to price target. So it's at 106.58 right now. What is the price target? Well, I don't know what the price is going to be because it's valued based on its holdings, and it's a purely mathematical valuation based on the shape of the yield curve and where yields are. It might be better to think in terms of a yield target. So if we think, well, the 30 years at 3.64, if we have a 3% yield, we see it approaching 3%, we should, in relation, expect to see TLT at 118.58. So we can watch the 3-year, and you can use this method to calculate a price target of what it would be at 3.5, 3.25, 3, 2.75, and it would be, it's not an exact number, but you're going to be in the neighborhood of where it would be. Then you can start thinking in terms of, well, rather than thinking in terms of a price target on TLT, is it more realistic and easier for me to start envisioning a yield target on the 30-year? So here is the market yield on the U.S. Treasury 30-year constant maturity. And there's 3% over here. So if we look across at 3%, and unfortunately it's just this thing keeps bouncing around, but you can see my mouse pointer is going across a line at 3%. 2012, 2014, all the way through the teens, we seem to be bouncing a little above 3%, below 3%, above, below. And now we're above 3%. Given a recession, getting back to 3% does not seem unrealistic. So if we can look at this and we can think better in yield, saying, well, where would the yield go? Then that would allow us to think about, well, what would that change in yield result in a price for a portfolio that has a duration of 17.6. Since there's a mathematical relationship between that, we can calculate. Now we're calculating a theoretical change in price based on its duration as opposed to empirical, but that's as close as we can get. We can get in the neighborhood, we may not get precise. So I don't see that a recession going from where we are now, it's saying here 3.66, getting down to 3% in a recession, I don't think is unrealistic. So as far as TLT is concerned, I am willing to roll up my puts. I can't see much more upside to rates. I don't know that the Fed has 100 basis points left in it. So I am going to continually roll up my puts because I do think that the highs for the yields are probably in. I think the 0% probability for the next meeting is probably where I would be as well. Yeah, just different perspective on how to look at TLT. Okay, for OAS, we do have some interesting moves here. For investment grade, a drop of 9 basis points on the spread. The AA and the BBB, the upper and the lower, not quite the upper. There's no point in looking at AAA, but AA down to BBB. The range in investment grade. All the investment grade ones have decreased, whereas high yield spreads are widening on all of them. On high yield as a group, and the upper level of high yield, BB, all the way to the lower level, CCC, are widening. So there is some things going on in the OAS, but you're still sitting around 500 basis points here on the OAS. Recession levels are about 800. So it's the credit market is kind of saying, maybe, but it's not really where the bond market is. The bond market is saying, oh, yes, we got a recession going on. It's going to happen. It's coming. The credit market is saying, maybe, but investment grade is going to be fine, so maybe we'll move a little on high yield, but we're not convinced, is what it's saying. Looking at comparison for yields, a 1-year UST is 4.32. The 1 to 3 year investment grade sitting at 5.12. Points are starting to come into this. Last week was 132. This week is 80 because investment grade is getting a little bit more expensive. High yields getting a little bit cheaper. Mortgage rates 6.42 dropped another 18 basis points week over week. On the back of a 25 basis point hike, mortgage rates have come down 18 basis points. Looking at a Thursday over Thursday change in the 10-year, it has dropped 18 basis points, and we have to use Thursday over Thursday because we don't have Friday rates here, we have Thursdays. 30-year fixed rate mortgage has dropped 18 basis points, so the spread is unchanged. So we look at our mortgage rates. Agency is up 0.51%, Annaly's up 2.88%. If you have the spread widening, these tend to drop in price. If you have the spread narrowing, these tend to increase in price because they are highly levered to the spread. The builders and KB Homes had their earnings this week, and look at this, up 14.54% week over week. The XHB up 0.4%. DHI kind of flat, down 0.52. Lennar was up, Toll Brothers was up, Pulte Homes was up, and these are very sensitive to the level of the fixed rate mortgage. Fixed rate mortgage is down, so they are all up. MBB, which is an unlevered mortgage-backed security ETF, up 0.54%. Rate and spread sensitive. This is MBS spread, not 30-year to fixed rate mortgage spread. This is a good proxy for the MBS spread, but not exact. But we know the 10-year has dropped in price. So if the spread stayed constant, we would expect MBB to be up 0.54. Mortgage applications. And the banking crisis is already out at this point in time because this is the week ending March 17th. So the mortgage market is already aware of this. Mortgage lenders are already aware of this. Mortgage applications up 3%. Refis up 4.9%. Purses up 2.23%. Existing home sales, big news there. For February, up 14.5%. So good activity in existing home sales. The more exciting news here, especially for the Fed here, the median home price actually dropped. And this is the first time in 131 months that you haven't had a year-over-year increase in the median home price. Year over year, the median home price dropped. That breaks a 131-month record, the longest streak on record. That's big news. New home sales for February up 1.1%. Housing market, look at this, mortgage apps, good. Existing home sales, new home sales, mortgage rates coming down, the index up, almost all the home builders up, everyone's reported earnings, they all have blown it out of the water. KB Homes following along as well. It's just an incredible sector, and it's a sector that is massively underbuilt right now, and especially with high rates and the lack of spec housing being built. Once we get out of this, once we get past the recession onto the other side, this is I think for the portfolio I would have for the next cycle, the next expansionary cycle. Home builders are front and center. In fact, I think that in the next cycle it will be characterized by two types of companies. Those that have a clear cost of capital advantage, which means the biggest players in the industry. So DHI and Lennar in home builders, I think, will have a clear advantage over all the others because they do have an advantage in cost of capital. The larger companies that do have an advantage in cost of capital, which means your investment grade companies. The other ones will be the ones that don't require any debt whatsoever and have huge cash flows. And those, well, they're across a bunch of different sectors. When I say have no debt, they may have some debt in their capital structure, but that their type of business doesn't necessarily rely on debt, so that they have very low leverage, very low financial leverage. I think they'll do fairly well. What I don't think will do very well are the REIT sector. I think they've had their time. I just don't see where the upside is going to come from. And if we're looking for a housing market, especially in new home construction, that is going to be constrained significantly, it's Canada. Now, I know that there have been some reports out about the expectation that Canadian banks are going to suffer badly because of their exposure to housing, and there has not been another market on the planet other than Canada where home values have gone up so much. Considered one of the most overvalued markets, that there's a correction coming in Canadian housing. And since we have a lot more variable rate mortgages than the US, and even if you have a fixed rate mortgage, you tend to have a 5-year fixed rate. So you might have a 25-year amortization period, but a 5-year fixed rate mortgage, which means after 5 years, you have to go back and renegotiate another 5-year term on your mortgage. That is going to cause some grief. But what is missed is the other side, is Canada. If you remove all the African countries, Canada has the highest population growth on the planet. Sounds hard to believe, right? It's because of our immigration. We had the highest level of immigration over the last year, over 1 million for a country our size. So if you remove the African countries, Canada has the highest population growth and plans to continue on that trend. Well, where are they going to live? Where are they going to go? We already have a significant housing shortage, and you want to bring in that many more, and you're suggesting we're going to get a housing correction? If you look at the apartment REITs, all of them are sitting at 97, 98, 99% occupancy. Where are they going to go? The apartments don't exist for them. The housing doesn't exist for them. So we have a massive shortage of housing on a go-forward basis. So I just don't buy the theory that the Canadian banks are going to suffer because Canadian housing is going to suffer when you are putting that many people into the country that have to live somewhere. They have to live somewhere. So I just don't have the numbers in my head to see how housing can drop 20% without buyers massively stepping in on any dip. On any dip. I still look at realtor.ca just to see what prices are in the region that I'm in. And yes, they are down from the frothiness of the beginning of 2020, but not down to the point where I would say, oh, wow, look at this. Look at the prices. It's like, well, okay, so, it's not $9.59 anymore. It's $9.19, but okay, so it's down like 3.5%, 4%, but nothing really exciting. Listings that were 1.5, 1.6 are now 1.4, Okay, well, they probably had no reason at 1.6, but still 1.4 for that. If you go back 20 years ago, that was a $450,000 house at best. So I think U.S. housing, absolutely. If I could find something good in Canada, I would jump on board that. But it doesn't have the same type of availability and variety that the U.S. market offers. Okay, let's look at initial claims along with the effective federal funds rate. And to get them on the same chart, you're going to have to multiply the effective federal funds rate by 100,000 to match the same scale as initial claims, or divide initial claims by 100,000, but I think you lose some of the volatility that you see in the chart. Let's start with the bottom chart. This was from the period beginning of 2004 right into the credit crisis. And the dark brown line here is the effective federal funds rate. You can see it increase regularly over a period of a couple of years. And then for about a year, it hung out at 5.25% until the second week of August 2007. And then you had the market reacting to some events, but the Fed really didn't start cutting rates until much later. Look at this period of time here. You had a higher rate, 5.25 for about a year, but initial claims still hovering right around 320,000 during that whole period of time. That high rates were not creating unemployment. High rates on their own were not creating unemployment beyond what was week after week, pretty much in and around 320,000. One thing you'll note when you get to economic and financial data is you see the bouncing around that you see on this bottom chart here, the volatility around 320. If the number were 600, you'd see higher volatility around 6. That economic data and financial data tend to demonstrate volatility dependency on the level. So the higher the level of something, the higher the volatility around that. The lower the level, the lower the volatility. So this upper chart here is bouncing around 200,000. This was 320. This is 200 on initial claims, and we don't have that much volatility in around the 200, but you have a little bit more around the 320 because of that volatility dependent level. But the big takeaway here is that high rates are not the creator of unemployment. So we know the Fed wants to create slack in the labor market, so it's raising rates. But raising rates on their own is not what creates the unemployment. It's something breaking that creates the unemployment. And of course, something broke in this period of time and continued to break. And that is, and look at initial claims, you could see it moving way up, but not until well into the recession are initial claims week after week elevated. But it starts moving up a little bit before it starts to break the higher levels of wherever its volatility range was as you get closer to the recession. So I don't know that we can look to initial claims at this point in time to start seeing that slack is being introduced into the labor market. It is not until things really start breaking that initial claims start to increase. Now, we did have some breaking in the banking sector, but it seemed to have been, the authorities came in quickly. They contained it as best they could. They're putting the message out that everything is fine, everything is contained, everything is good, business as usual, nothing to see here anymore. I don't know that that was enough things breaking to create slack in the labor market. I don't think the Fed is going to get the slack endogenously with just a high rate. Something endogenously has to break or exogenously has to happen. Some random event that then starts a cascade of events that can't be contained. That is what's going to introduce slack into the labor market, not high rates on their own. Okay, let's do the same thing with the Fed funds rate, except this time we're going to use continuing claims, because we could have a situation where companies are saying, we're not laying people off, but we're not hiring anybody, which means that you may not have a lot of initial claims week after week, but those that show up for unemployment simply don't get a job after that, so that your continuing claims would increase over that period of time. Let's find out if that was going on at that time. We'll start with the bottom chart over here. There is the increase in the Fed funds rate. There is 5.25. Over this period of time, the participation rate hung very closely to about 66%. Unemployment hung very closely to about 4.5%. And initial claims fluctuated between 2.4 million to 2.6 million. If we go to the upper chart, this is the recent period. There is the increase in the effective federal funds rate. Participation rate much lower than 66%, 62.2 to 62.6. Unemployment sitting around 3.5 to 3.7. Well, that can be explained by just the much lower participation rate. But initial claims fluctuating between 1.3 and 1.7 million. Look how much lower that is compared to the 2.4 to 2.6. You got 1.3 to 1.7. So it's not really having that much of an effect on continuing claims. It's near the upper end of that range, but during this period of time, it fluctuated within a 200,000 person range. This is fluctuating within 300,000, but yeah, well, you could say, well, let's see what happens going forward. Well, that's all we can do. The Fed wants to get PCE services ex housing down, and we're going to put a 2% target on there, thinking that that's where it's got to get. Well, the participation rate here has got to increase to introduce slack into the labor market, to take pressure off of wages, because PCE services, right, ex-housing, is really labor-driven. And they have mentioned that before, that 55 to 60% of the cost structure of that category they're looking at is wages, that it is labor-driven. So you got to get the participation rate up, and I have a little F in brackets in front of or, meaning for or. The participation rate has to increase for unemployment rate to increase, or in lack of a participation rate increasing, the unemployment rate just has to increase, which means people have to lose their jobs. So either more people have to show up who want jobs but don't have it to introduce slack into the labor market, or people have to lose their jobs to get from 3.5, 3.7 to they have 4.5 in the summary of economic projections for year end. So it does not seem that the high rate on its own creates unemployment in that we can see in initial claims, nor does it create continuing unemployment or a condition of continuing unemployment during that period of time if we look at continuing claims. I don't know that we're going to get much there. In the previous scenarios, unemployment increased not because rates increased. You can go back to other periods of time and look at this as well. It's not because rates increased. It's because something broke in the economy. That's where you're going to get the unemployment. If they want to get to 4.5%, they know they have to break something. And they're never going to admit ever that they want a recession to happen. They're never going to admit it. All they're going to say is, we've got to introduce some slack into the labor market. There is no other way with the interest rate to get that. The interest rate won't do it. The interest rate will cause something to break, which will do it, and that's how they have to do it, through that transitive property of the interest rate destroys this. This then destroys employment. Okay, let's revisit Bitcoin and gold again. Gold, week over week, down 0.63. Tried twice at the $2,000 level and failed both times. Failed considerably here, in the process of failing here, but if the pullback isn't that far and it makes another run for 2,000, you could say, well, you've got a double top forming. There are no triple tops, right? At least the expression is. Bitcoin up 2.85%. There's your FOMC meeting right in there. Negative for Bitcoin on that one, but still up 2.85%. So there does seem to be a move away, as long as this banking crisis continues, or the effect of it continues, a move away from currency. Money market funds up 120.93 billion last week. Up 117.41 billion over the previous week. The week before was up 120 billion. So money is still flowing into money market funds. Retail up 15.21 billion. The week before was 20 billion. Institutional up 102 billion. The week before was 100 billion. Money market funds now sit at 5.13 trillion versus 5 trillion the week before. So money is flowing out of other assets into money market funds. Not so much into gold, still a little bit more into Bitcoin, but not that much. I have heard 100,000 and 1 million on Bitcoin in the last week. And when you start hearing those really frothy numbers, somebody says 100,000, you go, oh. And so he says, no, it's 1 million. It's like, okay, now we're jumping the shark here. You're jumping the shark. But it didn't seem to have the excitement in the last week that it had the week before. The week before was up like 34%. It just doesn't seem to have that excitement this week. Well, let's just see. I'm not interested in Bitcoin at all. I have no interest in it whatsoever, but I do think it is acting as a barometer of what the sentiment is in the general market. I don't think that this is a speculative exuberance in Bitcoin right now as much as it is not running to Bitcoin, but running away from something else. Okay, yen and peso. We can see the FOMC here. Yen got stronger and the peso got weaker, but not by much. The peso gained 2.45% week over week. The yen gain of 0.86% week over week. Japan CPI basically had no effect on the yen. It came out, it was a little bit lower than expected, but really had no effect. My game plan on the yen is to sell the pair at anything over 132.50. When I'm selling the pair, the action is on the first currency, right? If you're selling the US, you're long the yen. If you're buying the US, you're short the yen. So whatever you want to do, look at the first pair and say, well, am I buying or selling the first of the pair? You can also look at the second and say, well, am I buying or selling the second of the pair? But you have to think backwards when you do it. So it's easier just to use the US and figure out which direction you think the US is going. For the peso, I'm not going to do anything with it. I'm not going to short the peso in anticipation of a recession, but I will buy the yen in anticipation of a recession with a recession target of 115 to 120 on the cover. Because the yen always performs well in times of fear, in times of crisis. So if you do have a recession, if it is a global recession, yeah, I can see a yen target under 120 as an initial target. It depends on the depth and duration, right? And mostly the depth. If the recession's looking really bad and you're getting just cascading effects globally, yeah, the yen could even get to 110 or 105. Recession target on the peso, this is where I will step in, is the 20 to 22 range. So I'm out of the peso now until I see 20 to 22. Basically what will happen is the yen will strengthen to under 120 while the peso weakens to over 20 and even upwards of 22. It could go even further in a deeper recession. I've seen it go to 24, 25. But I wouldn't be stepping into the peso unless it was a recession play. Then I would be selling the pair. And when you're selling the pair, you're short the US, you're long the peso. Here, anything over 132, I would sell the pair, so short the US, long the yen, but I would cover somewhere under 120 to 115. And again, it's hard, you can predict that conditions are right for a recession. What kind of recession? I don't know, because it depends on the type of event that causes the recession. But one thing is for certain, events always happen. And we have the economic conditions under which if an event happened, it can cause the recession. It is the magnitude or the nature of the event that will determine the magnitude of the recession. So I can't really say, oh, I expect a deep recession, a shallow recession. It would be like, you tell me what happens and I'll tell you what kind of recession we can get. But you can't tell me what happens because it's completely random. Something's going to break somewhere at some time. That will cause a recession. Then I'll have more information to determine, well, is this a 115 to 125? Is it a 120 to 125? Or is it a 105 to 115 target in there? And that'll give me the target here. But that is my next move on the yen. Okay, getting into commodities. Telling a different story. Copper up 4.5%. West Texas Intermediate up 4% for the week. Brent crude up 3.05% for the week. Gasoline up 3.76%. We look at the miners, FCX, Freeport up 4.96. This is my number one pick, by the way, that if I had to go into the next cycle with one mining company, it would be Freeport. Rio unchanged on the week, BHP up 0.98, PIC up 1.3. Now when I say number one, I'm not saying I don't want these. It's just if I had to pick one, gun to my head, it would be Freeport. Oxy down 0.48%. I will continue to sell puts on this one. Warren Buffett seems very eager and very interested in this one with the number of shares that he's purchased and the ownership that he has. And since he truly is diamond hands, he holds his positions. The more he buys, the less available shares there are, the less volatility there's going to be, because you don't have all those shares are, for all intents and purposes, off the market. So I will continue to sell puts on this, but not sell calls. Still watching Brent on a sell-off below 70. Things could get bad for the energy sector, but it is holding above 70, 74.57. It did eke out a gain last week. All the commodities, well, the commodities that I watch eked out a gain, and the miners are showing solid price action as well, which is kind of counter to expecting a recession. You think, well, if there's going to be a recession, there would be a pullback in some of these, in especially energy, but and especially in oil. But you see that up in the next cycle up. Copper. If you are having this transition to EV, if you are having a transition to a green grid, EVs take triple the amount of copper, sometimes even 4 to 5 times as much copper, depending on what vehicle you're making, than internal combustion. If we are short housing and we have to build a lot of housing, lots of copper pipe, copper wire goes into housing, and electric, anything electric is copper. There's nothing, the electrons fly fast through copper, half the speed of light. And there just isn't enough mineable copper right now, the capacity to produce copper to meet all of that demand. The price target that I think it was Goldman Sachs has on copper is $12,000 a ton, which puts it well over $5 a pound. It's sitting at low fours right now. 4.75 to 5 was the last high point. That was considered high. This would put it well over 5, almost at $6 a pound. So that is based on $4. That's a 50% upside to the price of copper right now. Okay, lots of writing on this screen, right? Let's start at the top. Our forward 4-quarter estimate for earnings, 219.16. Last week was 219.46, down 30 cents. It's just been fluctuating around the 219 to 220 for the last couple of weeks. Look down in the description box. The link to the spreadsheet from S&P Global is clearly marked. So you just put that link in your browser, hit enter, and you will get the spreadsheet downloading. And from there you can open it up and you can find all of these numbers. Broken down by quarter, Q1 through Q4, these are the earnings expected per quarter, share weighted earnings. And for 2024, you're looking at 245.99. Does that even seem realistic to you, that you could be forecasting that earnings are going to be the highest they've ever been for 2024, the highest they've ever been? Think about 2021, all the money floating around. It's gonna be better. It's gonna be better than that. It's gonna be a better environment than that. These estimates have to come down. These are all bottom-up estimates. Bottom-up estimates are typically guidance-driven. So it's company guidance that really forms the bottom-up estimates. And of course, companies are not optimistic at all. They're usually the most pessimistic. Well, what am I saying? Come on now. So there's a lot of optimism built into these numbers. Morgan Stanley's more around 210, and most of that side of the market are sitting around 210, as opposed to the bottom-up consensus using guidance of 220, sitting around 210. In fact, they have a base case of, I think it was 195. Optimistic of 210, and in recessionary levels 185. So even at 210, And there's also the question of the multiple, sitting at closing of 39.71 using this 4 quarters. We're sitting at almost 18 times forward earnings. In an environment where the Fed is saying we've lowered our real GDP forecast to 0.4% for 2023 and looking at creating an extra 1% unemployment, that you're willing to pay a forward multiple of 18 times earnings in that environment. So I do think that the 210 is not unrealistic. It's not as if somebody would come along and say, oh, 210, that's way too much. I think you're going to 185, you are at recessionary levels at that point. But saying, well, given the tightening in credit that is inevitably going to happen because of what we've seen, 210 is not unrealistic. And do we really want to pay 18 times earnings in the environment that we're going to see for the next year? Well, let's say you put it at 210 at 17 times earnings. You're still below 3,600. You're around 3,600, if not lower, which means even without making much assumption, just taking 0.87 off the multiple and taking just $10 off the forward earnings here, you are revisiting the October lows. I do think that is a not unrealistic assumption, that if somebody said, are we going to revisit the October lows? Surprised if we didn't. I'd be surprised if we didn't, at a minimum, revisit the October lows. June ES finished at 4,010.50. My break even is much higher than that. I'm in the money on these, but I am not closing them. I sold more June ES. I sold September ES as well. In case you're wondering why I sold September ES, is because September is here, June is here, but you have options in around this date here that have September as the underlying. So even though June expires here, if I want options that are just 1 day later, I have to use the September underlying, or it will be the September underlying. I'd rather be short the September underlying. If I'm using options to hedge out, I'd rather hedge out the right one. And I sold more 4,000 calls with the September underlying with them as well for June 16th, which is the same day that the June contracts expire. I could have used the June underlying, but that means the options expire in cash if they expire on that date. I want the options to expire, and if something is going to happen, I either want something called or put to me, which would be the September contract. So I'm using the same date, June 16th, but the September underlying on this. I sold more of those. Implied volatility down to 58% from 97% the week before. So this past week saw the S&P eke out a gain of 1.4% and really calm down. Implied volatility down to 58%. Over the course of the week as well, I closed quite a few puts. You'll remember a couple of weeks ago I told you I sold a whole bunch of puts on stuff. Well, I closed quite a few of those puts. I did buy more agency I think I got a price out at 950 and I got hit at 950 for some more agency. I'm fairly comfortable holding agency. I have no issue with that at all, and it pays a nice dividend, and I'm not concerned about the level of the dividend. So we're sitting at 17.87 times forward earnings. Comparing it with some other yields, that is an earnings yield of 5.59. The 1 to 3 year investment grade 5.12. So there's 47 basis points of extra yield in moving into equities. When I say extra yield, again, the middle of a distribution, right? It's the middle of a distribution. A distribution with volatility. So you'd like to see a wider spread than 47 basis points. So every week I get this question, is why are you comparing the yields? It doesn't make sense. It's just one way of looking at what you're getting paid for volatility. So let's draw a line like this, and we can say, well, the 6-month T-bill is here at 4.76. You have the 1 to 3 year, which is over here, and the you have the earnings yield here, 5.59. Well, the 6-month T-bill, if you buy a 6-month T-bill, there is no volatility, there is no variability in your return. It is just a straight line. It is a point estimate. There is no distribution, because there is no uncertainty to your return. There is no risk. Now, if it were a coupon-paying bond, there'd be some uncertainty because you would have the reinvestment of the coupon perhaps at a different yield than what you bought the bond at. So there would be some distribution of returns that you would get, but a 6-month T-bill is just a straight up and down line. It is a point estimate. For the 1 to 3 year investment grade, because it's coupon paying, it's the middle of a distribution with some variability in your return because, well, you could reinvest at higher rates or you could reinvest at lower rates. So the yield that you bought the bond at may not be your yield to maturity, depending on what you can reinvest your coupons at. And then you have your equity, which has a much wider distribution of possible outcomes. So the question becomes, is this enough? This difference in here, between here and here, is this enough of a spread between yields to compensate for the possibility that you could have this kind of outcome? Yes, you can have this kind of outcome. But these are somewhat symmetrical distributions that if there's a promise of upside, it comes with a threat of downside. Is that enough of a spread between those two to compensate? Look at the overlap in the tail down here, right? So if you have this probability, and because we can use a perfect form, which is a normal distribution, and it has very well-defined features, we can figure out, if we use something like shortfall risk, we can figure out what the probability of being lower than the 5.12 based on what this yield is, and ask ourselves, are we comfortable with a 43% probability of underperforming investment grade simply because of the price we're paying for the equity market? Well, 43% probability of underperforming something with a very low distribution of returns. Are you comfortable with that? Maybe you'd be more comfortable saying, well, there's only a 20% shortfall risk from the investment grade bond. Well, that may make more sense, but maybe 43%, you think 43% is stupid. Why would I take on that much risk? Clearly, the equity market is overpriced at that point. Relative to what I could get the investment grade for. So, there is, if you think about it in terms of the distribution where the yields are and the distribution around each of the yields, it makes sense. The 30-year Treasury, 3.64. So if we're thinking about the equity risk premium, you want a long-term risk-free rate. Can't use the 20 because there just seems to be some kind of clientele effect around the 20 that makes it disjointed between the 10 and the 30. 195 basis point difference. We'd like to see that around 400 to 450, and it's sitting at 195. The way to get it there, you can get the U.S. Treasury to get lower yields on treasuries. Money's got to go somewhere. That justifies a higher price on the market. But if you're going to have a 30-year Treasury at 3.64, you cannot be paying 18 times forward earnings on this market. Here's what we've seen so far. If we look at risk-free yields, the first screen that we were at, the Treasury yields, they seem to be expecting a hard landing, that the Fed's going to have to cut rates and cut them significantly. If we look at the OAS, it's a big okay. Investment grade says we're not worried. High yield says, well, I'll give you a little bit today. I'll give you a little. We look at equities, it's saying no. It's not budging from 220, and you're going to pay almost 18 times forward earnings for that. Who do you believe? You got a hard landing, you got a no landing, and you got a, you know what, we don't care. Leave us alone. Friday's put-call ratio 1.5, kind of low. Put-call open interest 2.01, it's kind of dropping, but that's typical going into when we have a weekend where you might expect good news to break out. And the good news that we're expecting to break out, which is what caused the rally throughout the rest of the day Friday into the close, was that there was more meetings being held this weekend to possibly extend depositor insurance to everyone. Well, you don't want to be short going into a weekend where good news can break out. This is consistent with fear that good news was going to break out. That's what that rally was for, is that, well, I don't want to be on the wrong side of good news. Implied volatility dropping to 19.3 for the week versus 22.3 last week. So we can really see that it's come out over here. So beyond the just week-to-week fluctuations and the market responding to each news story. Okay, well, they're going to protect all depositors going forward. Yay, that's good news, and everything is fixed. Well, everything is not fixed. The sentiment from the banks is still there. Credit is still going to tighten up. It's going to be tighter going forward than it was a pre-crisis or pre-mini crisis. Even Powell in his press conference said, look, the tightening of credit from banks acts like a rate increase to begin with anyways. If you watch the video I put up yesterday about the Minsky moment, one of the things that I think that the market isn't discounting is that speculative finance phase where you have short-term debt. I'll just put SD for short-term debt, financing an asset that is more long-term, and this is really commercial real estate in here, and you have a lot of that coming due, both public and private stuff that you probably never heard of. And the regional banks tend to have, in terms of the percentage of their loans, tend to have a far greater overweighting of commercial real estate in that sector. I don't know that that is crisis level stuff as much as it is much lower earnings stuff, much lower earnings from the real estate sector. Because if they are going to get refinanced, it's going to be at a punishing rate. So the NOIs, I think, have probably peaked out and are going to drop across the real estate sector. And it's going to be lower earnings for banks because of higher loan loss provisions. And if credit is tightening up, well, that is going to have an effect on consumers, on some consumers and some businesses. And if some businesses and consumers are, hit with higher costs to service their debt, well, that's a dollar that doesn't go somewhere else. That has to hit aggregate demand. This 219 is too high. Period. That 219 is simply too high. So I'm thinking 210 is not unrealistic at all. And I think 18 times is simply too high. That if you brought 210 down to 17, I think you're under 3,600 at that point. Let me just do it in my head quickly. And that's 17, it'd be 3,570, which is really revisiting this area of congestion down here. You're probably going to revisit the lows on this one, which is why I'm staying short, and I've added to my short position. Not only have I added to my short positions, I've closed these puts as well. And I'm resisting the urge to short individual names. I was going to sell more calls on IYR. We see IYR has finally broken 80 and on its way down. I would not be interested in the IYR until it's in the mid-50s, which is where I think it has to get to. So it is high 70s right now. I think it gets to mid-50s, especially in a recession, maybe low 50s. There I would be interested in selling puts on IYR at that point. But I don't see it's recovering back to over 100 in the next cycle. But I would be interested in selling puts on IYR at that point. Why am I not going to short it? If it's just sitting below 80 bucks and I think it's going to get to 55, why not just put a short on IYR? Or why not just sell calls? Sell in the money calls. Go out to December and sell the $60 calls on IYR like I did last year with TLT. Sell the 135 calls when it's at 160. It's because the correlation right now between SPX and the higher level sector ETFs, each of the sectors, is so very high that it's the same bet. Why should I short IYR and have higher margin requirements when I can sell a September ES or a June ES with lower requirements and I have a correlation that is in the 0.9s or higher? It's the same bet. Short the real estate sector, short IYR, or short ES, I'm making the same bet. So I'm not diversifying my bets at that point. And I look at the two and I say it's much more efficient from a capital perspective to either sell a call on the market or short the market than it is to sell a call on IYR or short IYR. And since the correlation is so high, I'm not getting any diversification benefits. If I really want to short IYR, I should just short more of the market, which is what I did. So I'm resisting the urge to short IYR because it's an inefficient use of capital that if the market doesn't go down, IYR won't go down. If the market recovers, IYR will recover. So I may as well just be all in one place where I can do risk management all on one underlying, which is the futures for the market. But at this point, I'm pretty much convicted on my short position probably until we get to around 3,600. I can't see how we're not going to. I can't see it. Earnings are too high. The multiple is too high. Those two things. Now, if we were sitting around 210 and 17, then I would say, well, you know, can we get to 200 at 16? That's going to require something significant to break somewhere. But I think even if nothing breaks, 210 is not unrealistic and 17 is not unrealistic. If nothing breaks, we stay in this condition. With elevated rates, we stay in this condition longer. So if you go back to yesterday's video and you think about all the companies that engaged in speculative finance, which sounds bad, but it's not. It's really just mismatching their liabilities with their assets. It's using short-term liabilities with the promise of rolling over their debt to finance longer-term assets. Lots of companies do that for cash management reasons or for liquidity reasons. Not so much liquidity reasons, but because they feel that they can continually access credit markets. And there we are. That's my position right now. I'm probably more concentrated in my portfolio than ever before because I don't have all these puts in place anymore. And every decision I'm making seems to be on rallies. I'm just shorting the market, taking bigger shorts. And every time I short something, I'm also adding a call as well, as opposed to, saying, well, let's short 10 contracts. I'll short 5 contracts and do 5 calls at each time. And I will continue to do that until situation changes where I have information or data comes out that says I am completely wrong. I'm just not seeing where I'm wrong. Right now, I think the market is wrong. Okay, let's look at our calendar for the week coming up, and let's just have a preview for earnings. Okay, Monday, not much going on to change our mind. Let's pay attention that throughout the week we get a whole bunch of these of the district Fed indexes coming out. Here's Dallas Fed Manufacturing Index on Monday. If there was only one through the week, it's like, well, that's one region, but there's quite a few of them coming out this week. There is Jefferson speaking. Heading into Tuesday, not much exciting going on here. Consumer confidence. Let's see what that comes in at, considering that the banking crisis has now had time to filter through into people's psyche. And then Barr starts 2 days of testimony. That will probably dominate. Bloomberg. You have Case-Shiller Home Price Index coming out Tuesday morning as well. There's Richmond Fed, followed by the Dallas Fed as well. Like I said, there were quite a few of them coming out this week. Going into Wednesday, you always get mortgage applications. There's Barr going on as well. Pending home sales as well. If you're into the oil market, you're getting all of your inventory reports at 9:30. Not much going on there. Thursday, GDP. We've already seen it's our final look. You get 3 looks at GDP, right? You get the first, the second. Well, you get 3: the first, the second, the third. I'm not saying anything exciting there. This is the final look at it for Q4. Usually not many changes, but we have this continuing claims. Let's keep watching that. I don't expect there to be any signal in continuing claims and initial jobless claims, like I've already explained, not until something really starts to happen. And on Friday, let's just go down to Friday, there's PCE. That'll be the big one that we look forward to. And then you have Michigan consumer sentiment. So we have two we have Conference Board and University of Michigan on the consumer sentiment. GDP kind of would be, I guess you could pay attention to it, but it's so backwards looking because it's the fourth quarter of 2022. And you have Friday, you have your PCE, and of course it's going to be core services ex housing that is going to get all the attention because that seems to be all the Fed wants to look at. For Thursday, with the initial claims and continuing claims, that will be watched, but I don't, again, as I've shown you earlier in this video, I don't think that that's going to respond to just high rates. It responds to the breaking of something, and I don't know that enough things broke for things to show up here. Let's have a look at earnings. Okay, this week we have consumer discretionary, consumer staples, information technology, Walgreens, Micron, Paychex. The week after, pretty much really heavy on consumer staples, Conagra, Constellation, Lamb Weston. Lamb Weston has just been an incredible stock over the last year. All through the rate hikes, it just kept hitting 52-week highs. And then you have one consumer discretionary, Yum Brands. And then this is this week coming up. This is next week. This is 2 weeks from now. We start with Q1 2023. Look who's reporting in here. First Republic. Along with Citigroup, JP Morgan, Wells Fargo, BlackRock. The financials lead off the earnings season. Usually it's financials, and then you have a whole bunch of information technology all mixed in with discretionary, consumer staples. But this, I would say, is probably going to be the most watched earnings season for financials, and they lead off right away. So we don't really have to wait until Act 3 to get to get the plot here. We're going to get it right away. So that is going to be a really interesting week, and I think this is also the week of CPI. So not only are you going to get the financials coming out, you're going to get March CPI at the same time. That is going to be a super volatile week. That, of course, is assuming that something hasn't completely broken before that date and that all of these earnings reports don't mean anything anymore because the event has happened. Whatever that event happens to be, we don't know what it's going to be or where it's going to be. But if it happens, then who cares? Then at that point, well, none of this matters anymore. Much like economic data hardly matters anymore because everyone's on recession watch, at least the bond market. The risk-free bond market, the government bond market's on recession watch. The corporate bond market just wants to be left alone, it seems. But this will be interesting. And that's it.